The third learning objective addresses how to make the drop, the product, and product mix decisions. Managers must often decide whether to drop products, departments, or territories that are not as profitable as desired. How do managers make these decisions? Here are some of the questions managers must consider when deciding whether to drop a product line, department, or territory. Does the product, department, or territory provide a positive contribution margin? Will fixed costs continue to exist even if the company drops the product? Are there any direct fixed costs that can be avoided if the company drops the product, department, or territory? Will dropping the product, department, or territory affect sales of the company's other products? What could the company do with the freed manufacturing capacity? Once again, we follow two key guidelines for special business decisions. Number 1, focus on relevant data, and 2, use a contribution margin approach. The relevant financial data is still the changes in revenues and expenses, but now we are considering a decrease in volume rather than an increase, as we did in the special sales order decision. Managers would use the same process in deciding whether to drop a department or territory. This exhibit shows the company's contribution margin income statement by product, assuming fixed costs are shared by both products. Because the specialty DVD line has an operating loss of $420, management is considering dropping the product. The first question management should ask is, does the product provide a positive contribution margin? If the product line has a negative contribution margin, then the product is not even covering its variable costs. Therefore, the company should drop the product line. However, if the product line has a positive contribution margin, then it is helping to cover at least some of the company's fixed costs. The fixed costs that will continue to exist even after a product is dropped are often called unavoidable fixed costs. Unavoidable fixed costs are irrelevant to the decision because they will not change if the company drops the product line. They will be incurred either way. However, if direct fixed costs associated with the product are avoidable, an analysis needs to be performed. If the direct fixed costs saved when the product is dropped are greater than the lost revenues, the product should be dropped. Management must also consider whether dropping the product line, department, or territory would hurt other sales. In such situations, managers must also include the loss of contribution margin from other departments affected by the change when deciding whether or not to drop a department. Management should also consider what they could do with freed capacity. Managers should consider whether using the machinery to produce a different product would be more profitable than using the machinery to produce the dropped product. The decision rule as to whether to drop a product, department, or territory rests on the lost revenues versus the cost savings. Special decisions should take into account all costs affected by the choice of action. Managers must ask the following questions. What total costs, variable and fixed, will change? Are there additional environmental costs, for example, wastewater disposal, that should be considered? The key to deciding whether to drop products, departments, or territories is to compare the lost revenue against the costs that can be saved and to consider what would be done with the freed capacity. Decision rule for dropping products, departments, or territory. If lost revenues are greater than costs, do not drop. If lost revenues are less than cost savings, then drop. Companies do not have unlimited resources. Constraints that restrict production or sale of a product vary from company to company. For a manufacturer like Smart Touch, the production constraint may be labor hours, machine hours, or available materials. For a merchandiser like Walmart, the primary constraint is cubic feet of display space. Other companies are constrained by sales demand. Competition may be stiff, and so the company may be able to sell only a limited number of units. In such cases, the company produces only as much as it can sell. However, if a company can sell all the units it can produce, which products should it emphasize? For which items should production be increased? Companies facing constraints consider the questions shown here. What constraints or stops the company from making or displaying all the units the company can sell? Which products offer the highest contribution margin per unit of the constraint? Would emphasizing one product over another affect fixed costs? Decision rule. Which product to emphasize? Emphasize the product with the highest contribution margin per unit of the constraint. This short exercise reviews how to drop a product and other product mix decisions. Dela Fashions operates 3 departments: men's, women's, and accessories. Departmental operating income data for the third quarter of 2012 are as follows. Assume that the fixed expenses assigned to each department include only direct fixed costs of the department, salary of the department's manager, and cost of advertising directly related to that department. If Dela Fashions drops a department, it will not incur these fixed expenses. Under these circumstances, should Dela Fashions drop any of the departments? And give your reason. Dela Fashions should consider dropping the accessories department because relevant expenses are greater than the revenues, which will result in an increase in operating income if the department is dropped.